Okay, well, hello again to everyone, and thanks for joining us for today's webinar as we take a deep dive in on buy-sell agreements and best practices for maximizing your accounts receivable. My name is Alex Mitchell. I'm a communications manager here at Vachette and Lighthouse Lab Services, and I'll be introducing your presenters today before handing things over. First off, we'll be joined by Josh Yelen, Vachette's VP of RCM Strategy and Growth, and Lambrix, our VP of RCM Consulting. And we're very happy to be welcoming Dr. Stephen G. Ruby of White Coat Risk Management. He's a longtime friend of Vachette's, and we're very glad that he's joined us today to share his expertise. During today's webinar, we have three major learning objectives. Upon completion, you should be able to understand the premise of AR and its importance to an organization and different ways to account for your AR, how to manage and maximize your outstanding AR, and how to protect your AR in a disruption of a partnership by death or disability, and how a strong buy-sell agreement can protect you in that event. And with that, I'll be turning it over to Josh.
Thanks, Alex. I'd like to thank everyone for attending, and hopefully you can take back with you some valuable information on accounts receivable, how to manage them, and how it could impact your partnership or corporation in a key personnel disruption. Aside from your human resources and your capital, accounts receivable is likely your most valuable corporate asset. It has significant importance, including the ability to fund ongoing operations, invest in new technologies and business expansion, secure bank loans and floating lines of credit, allow for buy-in and separations of key members, and also a valuable part of a monetization event. Next slide, please. But in actuality, accounts receivable management is really cash flow management. It provides you with the liquidity to support ongoing operations and invest in your human resources. It allows you to invest in new equipment and technology, and it allows you to invest in corporate expansion. And this is the key to surviving and thriving in today's business environment. Next slide, please. But accounts receivable is not immune to time value of money, which can adversely impact your AR in a multitude of ways. And let me give you one example. Company A has a collectible AR balance of $1 million and needs cash flow, needs cash to float ongoing expenses. So they go to their banker. Assuming we have a 7th-month collection period and the cost to borrow is 4.5%, so prime plus a quarter, that 5 million, sorry, the number should be 5 million. That 5 million is only worth 4.78 million in today's dollars. So there's actually an economic loss of about $220,000 by letting that accounts receivable sit out there uncollected. So naturally, your banker feels sorry for you, but she too needs to conduct her business, so she gives you the money for the loan. In this case, there are specifically 3 detriments to not collecting your AR. Number one, you can have leakage from bad debt. So the longer the account sits in the AR, the more likely it is not to collect. Secondly, you're going to incur losses from the interest expense required to borrow money. And third, as discussed, $1 collected a year from now is worth less than $1 collected today. Next slide, please. So what's the best way to account for your accounts receivable in your P&L books on your income statement? There are 2 ways to account for accounts receivable. You can either do it through cash basis accounting or accrual basis accounting. Both have pros and cons, which I'm going to talk, but from a revenue recognition standpoint, you recognize cash upon receipt. So this is good because it's simple. Cash comes in the door, you book it on your income statement, it's recognized. And history serves as a decent, at best, indicator of future inflows, but predicting future is a bit harder. On the con side, it's difficult to project cash flows. Cash-based revenues are not reflective of current business trends, and economic factors will have a greater impact on revenue recognition. For example, inflation today. On the other side, you can do accrual-based accounting. This is when your revenue is booked when earned. So it's booked in your income statement when earned. Cash and revenue are essentially tracked on two different scorecards. The benefits to accrual-based accounting is it matches revenues to outputs. Additionally, there are various ways to account for accounts receivable in accrual-based method. You can use the allowance method, the bad debt method, a gross collection rate, or even a gross collection rate by payer. The cons are it's a lot more accounting work. It's significantly more work. It's harder to do. And there are various ways to account for it. So you got to choose the one that best suits your business. With that being said, let me turn it over to my colleague, Ann Lambrix, who's going to provide you with insights on how to best manage your accounts receivable.
Thank you, Josh. So Josh does a really good job of talking at this like a high level accounting standpoint. My expertise really is the accounts receivable management, looking at your monthly AR and really how you're supposed to be reviewing this and managing this appropriately so it doesn't become bad debt and a loss. So one of the things that typically here at Vachette, what we would say is a good report to make sure that you're obtaining either from your biller or your billing software is your accounts receivable by date of service. Depending on, again, your billing platform, there may be different types of reports to view your accounts receivable. You could view it by last worked, or you could view it by date billed. The reason that we always like to look at by date of service is because, again, your payers, so who you're submitting claims to, is looking and has timely filing limits by date of service. So it's really important to make sure that you're not looking at a report, for example, as last worked, because that is going to, you won't be able to apply the correct dollars by date of service by last work, because I could work, you know, an account that's over 365 days old. I could work it today and it's going to show up as in your 30-day bucket. So it's important to get a report by date of service. Also, by reviewing AR by financial class, again, in viewing several different types of reports. You can have a summary AR, which will tell you overall your accounts receivable by the specific date of service. So you have a 0 to 30-day bucket, 30 to 60, 60 to 90, so on and so forth. But really what's important is to make sure that that summary is broken out by your insurance payers and your patient bills and accordingly, because again, you can identify trends. You can ensure that you're seeing your accounts receivable move, you're seeing it turn. And if you see aged balances going past 90 days by payer, again, you can address accordingly. And then the same thing, your AR by financial class. I'm sorry, I skipped over and said AR by payer, but AR by financial class allows you to see where it's, you know, what financial class it's currently sitting in. So again, if you look at AR by payer, you're really looking at accounts receivable by the individual insurance companies. When you're looking at AR by financial class, it could have been billed to United Healthcare. United Healthcare left a co-insurance or deductible to the patient. And so AR by financial class will really place that balance in a self-pay or patient financial class versus in the United Healthcare financial class. So it's good to know and understand that, because we would expect that your self-pay or your patient responsibility buckets, your financial classes, to age out a little bit longer than, again, your primary payer financial class. We also, recommend that your biller, your billing software provides denial reports. This can be tied back to your accounts receivable, especially accounts receivable by payer. If you're seeing a particular payer age out, It's really good to start running denial reports and again, identifying trends. Are there claims that are getting denied, and what is the denial code? And is there something that you need to do to resolve that accounts receivable? And then contract management is a really nice tool that I see a lot of billing softwares and billing companies starting to develop, simply because this starts tying back the reimbursement, what you're getting paid on your accounts receivable, and making sure you're getting paid appropriately, and the adjustments that are taken off of your AR are correct. Next slide, please. Best practices. Again, I've managed accounts receivable for large teams, corporations, billions of dollars in charges. And one of the things that was really important is we had a distinguished team to work accounts receivable. We had a separate department to bill claims, a separate department to post payments, and a separate team to work our AR. I certainly recognize that not all our companies will have the personnel to support that. However, I think it's very important to separate team members working accounts receivable, because what I see a lot of is we have someone that's responsible for billing, posting payments, and then when they have time, and when I say when they have time, I kind of chuckle, because we all know a lot of times that doesn't happen. They're supposed to be working accounts receivable. So if you're having somebody try to be jack of all trades, very rarely, or what we see happen is very rarely does the accounts receivable really receive the focus that's needed. And then defining what working an account means. Again, what I see a lot of is where you have an individual that is basically just rebilling a claim. So it starts aging out. I'm submitting a claim over and over again. There's no picking up the phone or statusing an account online to see if the claim was received, if there's a denial, if there's something that's an issue on the payer's end that needs to be resolved and submitted. Again, what I spoke of initially is timely filing. If you miss that timely filing deadline, that aged accounts receivable, even though it is still sitting on your AR and you're valuing that, it will be bad debt. If you are billing past timely filing and you don't have supportive documentation to show that you've been working those accounts correctly and timely. So defining and making sure that the team understands what working an account means is a good practice for managing AR. Appeal submission. This is another good best practice, is making sure that your team, again, is appropriately managing appeals, understanding each payer's rules for appeal submission. Unfortunately, in claims and billing, and having a healthcare system as we have here, we have many different payers, and unfortunately many different expectations. So when your team is working an account and it's been denied, do they understand what their next step is, and what is the appropriate appeal submission documentation? Is there a specific form that the carrier requires? Is there a timely filing for appeal submission? I believe Medicare has a timely filing submission of 1 year. However, their appeal submission is 120 days. So once you get denied, if your team isn't working those denials timely, again, this becomes bad debt. And so even though you're valuing your AR as collectible, it will not be. And then finally, trending the issues. What I did in my previous role as managing a large central billing office was really, I really segmented my team, my accounts receivable team, to be payer specific. I found that this was very useful because they were able to become experts in, for example, United Healthcare or Medicare, depending on my large payers that I had. Some of my team had to manage many, multiple smaller payers. However, with my bigger payers, I put one person and they became experts in that payer. This was a benefit because they were able to right away trend the issues, and they also developed a relationship with provider relations with that particular payer. So they were able to once an issue was identified, instead of calling on each individual claim, they could go to that point person and say, hey, look, you've been processing our claims incorrectly. I need to submit a file and I need you to process, 200 claims at once. Again, trending the issues helps you manage your accounts receivable better because you're able to identify and make something a project versus having somebody spinning their wheels or spending a lot of time calling individual claims. So looking and running reports and identifying, going back to those reporting, what I use for good reporting for AR is looking at by financial class and by AR or by payer, and then determining, do I have an issue with one of these payers, and what is the issue? Is it something that I need to fix internally, or is this an issue with the payer? And once I identify that, if it is an issue with the payer, going to the payer and having them resolve it as a project versus, again, having my team spend a lot of time individually resubmitting or calling. Again, that's why trending the issues is a good practice. Next slide, please. So finally, I just put together a do's and don'ts. Do's, looking at your aged AR as a percentage of total AR. We at Vachette benchmark aged AR. We would like to see aged AR no more than 15 to 18% greater than 90 days. Now, I always like to share and educate to say that this is what we like to see. You typically have, most groups that I work with have a aged AR. So again, accounts receivable, you want everything is the majority to be billed and collected within 0 to 60 or 0 to 90 days. But there's always going to be a chance where there's going to be some work needed to be done to resolve either a denial or something gets hung up in a system and you have to validate or resubmit or have the carrier push the claim through. So you're going to have aged AR. 90 days, I think that's a great benchmark to look at. Depending on where you're at. Illinois, I always like to talk about Illinois because Illinois has state funded plans, and Dr. Ruby, who's going to talk next, he can attest to we've seen claims where they are processed and they wait for funds from the state, which the state doesn't have a lot of money, very little, so that those claims sit out and pend in the system potentially for a year or longer. The beginning of the year, they get some monies and they release some payments. And then towards the end of the year, you start seeing these claims held up. So again, when you knowing your business and knowing your payers and again, running those reports by payer, you can then identify, okay, well, HealthLink or Cigna, it's a state funded plan. And I would expect that this is going to age out, and so my AR may take longer on average than 90 days. But it's a good practice to look at your AR and benchmark something depending on your payer mix and looking at your aged AR as a percentage of total AR. So you define your aged AR and then what is that percent, and you manage that every month, knowing if it's going above that benchmark and addressing it as needed. Knowing your payer mix, as I mentioned, if you have payers that take longer to pay than others, that's going to skew, and again, you're benchmarking to 90 days, and unfortunately, it's just going to cause a lot of frustration. So knowing your payer mix, you can set the appropriate benchmarks for your individual practice. Reviewing AR monthly, making sure that the older AR is being resolved. One of my don'ts is focus on the new AR first. Again, I see this and you'd think that this would be pretty, self-explanatory, that you wouldn't work just the new business, but we see this all the time. And this really is in those smaller practices where you have somebody that's trying to manage billing the claim, posting the payment, and then they run an AR report, and either they run it by the newer or they run it alphabetically. So sometimes that old AR just gets pushed out month after month after month. Nobody's addressing it. And then your resolution, what I want to make sure that you're all looking at is if you do have aged AR, and when you're managing your accounts receivable, whether it's aged or it's just new business, are you getting paid? Or is it being written off? Because again, and accounts receivable is just showing you what you have remaining on the books. So you want to make sure that you also look at adjustments or write-offs so that you're also looking at, are you collecting on your accounts receivable? Again, when you're valuing that AR, you're valuing it as it's going to be collectible. And so you don't want to get into a situation where you believe you have $1 million in accounts receivable, and it's just adjustments that the biller never took. So it's either contractual adjustments or it was a big, write-off because of something that was billed in error, et cetera. Make sure you understand that. And then again, pretty obvious, don't ignore your AR. It is very important to be looking at it and managing it and understanding it. As I said, don't focus on the new AR first, and always have a plan to manage accounts receivable, having a designated person to do that, having someone like Vachette to help you, oversee that process with your biller or your billing software. If there's reporting that you need to run weekly, monthly, quarterly, how do you report on that? It's very important that you do, and it's a good practice. All right, thanks again.
All right, well, thank you, Ann and Josh, for that overview on AR, very informative. And we're now going to turn things over to Dr. Oh, actually, I guess we did have one more slide here, Ann.
I apologize.
you led me astray there. I'll turn it back over to you.
All right, so how do we help you measure AR? So again, these are things that Vachette would look at for our clients monthly. If not more timely than that, we do look for our billing companies that we work with to have some sort of report that we can help view this on a monthly, quarterly basis or yearly. Days in AR, we're looking to see how long your accounts receivable is taking to turn. I always say to turn, meaning when you bill a claim, how long is it taking to pay? Net collection rate. How much are you collecting? So really, for example, for March of 2021, after you take your adjustments, we would expect that net collection rate to be close to, again, 100%. Gross collection rate, how much you're averaging. So that's a very simple formula where you take your average payments divided by your average charge. And that gives you just an example of an average, how much you're getting paid per dollar, what you're billing out. Again, GCR by payer, GCR by financial class. These are all important things to note and to be able to be managing month over month and quarter over quarter, year over year, and looking for those variances. And if there are variances, really what we want to see is the variance to go up. We want to see better collections, but if they go down, we have to explain why and address and run additional reporting as needed. Different valuation rates for various days outstanding buckets. So what payer potentially would, again, turn sooner than others? Is it going to, are we expecting more denials where we're going to have to appeal? Is it going to, again, take longer to pay? Or is it certain procedures, not even days outstanding buckets, but certain pay procedures that we know are going to value differently? Percentage of bad debt to charges, average time from charge to billing, and dollars outstanding as a percentage of AR. These are all good things to measure your accounts receivable with, and things that, again, we're looking for reporting from billing to help manage your accounts receivable.
Okay, well, thank you again, Ann, for taking over on that last slide, and Josh as well. And now we will turn things over to Dr. Ruby to discuss buy-sell agreements.
Well, thank you very much. Like I said, I appreciate the opportunity of being here. Practices are worth a lot of money. You have your accounts receivable, obviously enough. You have your additional billables. You have equipment. You have all kinds of things that are going on, and often practices are owned by multiple members. And we don't like to think about it, but everybody will die at some point in time, and people become disabled. And these are very significant issues when it comes to disposition of the funds that practices have. Okay, next slide. So the question is what happens when a partner or a partner owner dies or becomes permanently disabled? Well, there are really two things that have to happen. The first thing is that the portion of the shares that the deceased had need to be transferred to another entity. In other words, they have to be acquired by the most likely or most commonly by the other members of the group. And also the second part is there has to be a payment to the estate or a purchase price for that portion that the company was owned by that individual. And in many respects, we think of this as a buy-sell agreement as a form of succession planning. Now, you have two types of succession planning. A lot of times when we think of the person being bought out at the end of their career, that's one way, but a sudden death or disability can be an unexpected point of succession planning that you often need to be prepared for. Next slide. So we have a Dr. Joe. Dr. Joe has a practice. He has 3 other partners, and he suddenly dies or becomes permanently disabled. And think of all the different things that can happen: heart attack, infections, chronic diseases, accidents, anything else. So the question is, what happens next? Okay, so let's assume that Dr. Joe dies without a buy-sell agreement. And I'm sorry, next slide here. And one of the first things that happens is with the management. I'll tell you what, Alex, you know what, you can just, I apologize on these with the transitions. You can just open them up and then open that whole slide up and I'll go from there. It's probably easier for everybody. Okay. So anyways, without a buy-sell agreement, one of the first things you worry about is the management. And then the partners are confused. They're worried. There isn't a plan in place. They don't know what's going on. They don't know who's going to take over stuff. They don't even know necessarily the different things that have to be done with that death or disability of the individual. You know, who takes over and who owns the shares? So the question is will Joe's wife or life partner will they have control over the shares, and will they become the new partner? Theoretically, they can. Some of the things that you have to think about is, can they legally own the shares? In some states, you can only own shares in a medical corporation if you have an advanced degree and a medical degree. So in some cases that can't happen, and that could put the shares in limbo. What about the remaining practice owners? Do they wish to have, you know, the spouse or the life partner become part of the practice? Likely not, because of the specialties and everything else. But that is something that's kind of in limbo without a buy-sell agreement. Okay, the next line there, Joe. All right, not Alex, I'm sorry. And then the question is will Joe's wife or partner sell the ownership components to the other partners, or will there be some contentious elements of it and they try to sell it to somebody else or a different company? The next thing that happens when Joe dies is the valuation of the shares. Okay, what are really Joe's shares worth? So there can be, like anything else, when there's conflict, there's fighting over the determination of the value. Obviously, the estate of Joe thinks the value of those shares is worth far more than perhaps they are, and the remaining partners think that they are probably worth less than the estate. So there's a lot of contentious components there. Part of the next thing is if they do come to a conclusion and decide on the amount, the question is, where will that money come from? In other words, that could be expensive. Even if you have a $2 million corporation and you have 2 individuals, basically means you might have to come up with $1 million to be able to buy out the one partner. And again, in other groups, you know, valuations of an individual share, you know, $1, $2, $3 million is not unheard of. So the amount of money that it'd have to come up to be able to purchase out the shares of the deceased or the disabled can be quite substantial. The question is how fast, who will pay for that, which was typically the other members of the surviving members of the corporation will have to buy that. And some members may simply not have the money or be able to have come up with the money to pay for those shares. Then from the decedent side, it would be how fast would that be paid out? There could be a lot of conflict where somebody may say, well, we'd like to have this paid out over a year, 2 years, 3 years, or 4 years. Whereas the estate may say, no, we'd like this paid out in 90 days to bring the entire estate to closure very quickly. So there's a lot of conflict there. The next thing is, what type of impact will this valuation have on the company? Will it impact cash flow or payments or anything else, or the company's financing? Could there be other call on various notes, different kind of things like that. So it can be a substantial upheaval in the company when they have this large source of unfunded mandate. And next is, what is the financial impact that will have on the other partners? Can they really afford that? What would they have to do to buy out the shares? What would they need a loan? And sometimes such events like this can cause such upheaval that it could even result in dissolution of the company. Next slide. Something also to consider is the legal components. We touched on that briefly, but the ownership and succession of the shares may be contested in a court of law or probate if there's issues on the ownership, the transition, or the value of those. The valuation may be contested legally in a court of law where they're suing over different valuations, and other red tape and legal issues can further complicate an already difficult time. Needless to say, not having a buy-sell agreement and having a partner die or become disabled during the active period of their career can be really, really disruptive. Next slide. So the pitfalls at the time of death, that there isn't a predefined succession of ownership, which can impact the running of the business. The company doesn't have a way of establishing the monetary value of those shares. The surviving owners are not prepared to pay for the deceased partner's shares of the company or disabled partner shares. And the surviving heirs or estate may not receive the value of the deceased shares in a timely fashion. And obviously, as I mentioned before, it can result in a lot of legal conflict. Let's go to the next page. Now we have Dr. Jane. Dr. Jane also dies or becomes disabled, but she does have a buy-sell agreement with her group. So the first thing is going back to management. When this happens, the partners have already discussed what will we do in the case of management with a member leaving either due to death or disability. So they spell it out. How is this going to be taken care of? How are they going to be able to make this transition? It's already been pre-prepared and pre-negotiated in a less stressful environment when everybody is looking at it from the same perspective rather than the conflict perspective of the decedent's estate versus the remaining partners. The question of who takes over has been determined, and in other words, as far as the management components, the company has already determined who can buy the shares. In other words, part of the share agreement says that perhaps only the company can buy back the shares, or that the shares are then equally divided among the remaining partners. It can be defined any number of ways in a buy-sell agreement. But the point of it is that they are all predefined decisions so that when something like this happens, there's no there's no surprises and there's no conflict over this. The management of the company is predetermined and not subject to being contested. And a transition to a new management is much smoother and more predictable. And obviously, the grief and all the other issues that occur with the loss of a partner is still there, but the confusion and the consternation over the money and the management has been largely eliminated. Let's go to the next slide. We talk about value. Again, the same type of thing. What are Dr. Jane's shares worth? Well, the buy-sell agreement can already establish the value of the company or provide a defined method for determination of the value of those shares at the time of death. Again, the nice part about this is this doesn't become a contested component. It's basically, you pull out a procedure and say, this is how we're going to establish the value. We're going to look at the accounts receivable. We're going to take a look at the money in the bank. We're going to look at the equipment that's there. We're going to look at the blue sky or anything if that's included. And then it could be a formula for developing the value of the individual shares. Now, one of the things that's also really important on the buy-sell agreement is the other part of the partners or the getting the payment for the shares to the estate or the individual who's disabled. So one of the things to be able to do this, if you think about it, if you have a buy-sell agreement, or if you have the loss of a partner, and if there's $1 million or $2 million valuation, you have to come up with that money at some point in time. It may come up with it immediately, or may come up with it over 2 years or 3 years, something like that. But regardless, that's a large chunk of money for the remaining partners to come up with. Now, one of the things that can be done during buy-sell agreements is actually creating the agreement, but then also funding the agreement. And there's multiple different ways of doing this, and we'll talk about this in a moment. But basically, one of the ways of doing this is to either have life insurance or disability insurance, and again, a buy-sell disability insurance policy on the partners. So the amount of money that's being paid out for the insurance every year is relatively small. In other words, maybe it's a couple $1,000s or something like that. But what happens in the event of the buy-sell agreement being executed due to a death or disability, that bolus of money from the insurance can come in, make the estate whole, and not put an undue financial burden on the remaining members or on the corporation. Let's go to the next one here. Next. So, okay, when Dr. Jane dies with the buy-sell agreement, as I mentioned before, the uncertainty of the death or the disability is reduced or eliminated. The management change issues are predetermined to be able to be taken care of. Financial elements of the transaction are pre-negotiated, so they're not up for conflict. The needs of the surviving spouse or life partner are addressed, and they can try to, again, resolve those very, very quickly with certain funding strategies for buy-sell agreements. And the potential for legal conflict is dramatically reduced simply because everything's been predefined and negotiated out prior to any period of time when there is conflict. So the ideal situation about a buy-sell agreement is it's pre-negotiated, it becomes predictable, it becomes seamless, it's fair to all the parties, and it's expedient. Next slide. The advantages of having the buy-sell agreement also includes a predetermined and controlled market for the shares of the company, so you know who's going to be purchasing those shares and where they're going to be transferred to. It helps control the management of the company during the difficult time, and it provides the income and resolution of the owner or heirs, and including to be able to have the funds to conclude estate obligations in a timely fashion. So let's take a look at some of the types of agreements for the buy-sell. Just bring those all up there. The first one is an entity buy-sell agreement. And what happens here is a business is established to be obligated to buy out the owner of the shares in the event of a death or disability. Okay, so the business would actually come up with the money, and then you can determine what's going to happen with those shares after or where they're going to go. So it may be that the business brings in the shares and then they have the opportunity to distribute them among the existing partners, or perhaps the business will hold them and use those for the acquisition of a new partner to be able to buy those. But it gives them some opportunity there. Regardless of that, though, the business is obligated to pay out to the deceased or disabled partner the value of those shares. There's another entity called a cross purchase, and this is when owners are obligated to buy each other's shares. And in this case, the owners own life insurance or disability policies on each other's, and they are able to be paid out from those policies to be able to pay the decedent estate for the value of those shares. There's also one-way agreements for key employees, which you typically, we're really not going to talk about here, but if there's a key employee who's going to be buying the company in the event of, let's say, a single owner company, that's one way of doing it. And then, of course, there's always the ever famous wait and see, which is probably the most common thing that most people do, not necessarily out of intentional decision, but just by default. And that's the business or the surviving owners have the option to purchase the interest of it at the time of a triggering event. But typically it's kind of it's like we're not going to do anything, and we're just going to hope that nothing ends up happening. It's kind of the wait and see type event, which is obviously, I don't think, an optimal way of handling this. Each option has advantages and disadvantages, obviously enough. Determination of which structure is best for your company and your particular situation really should be made by sitting down with a qualified attorney who knows how to construct these buy-sell agreements and buy-sell agreements with all the parties that are involved with it. Really, there's two elements to this, and that's the development of the agreement, and then there's the funding of the agreement. So let's go to the next slide. Next slide here. What are the key elements of the buy-sell agreement. In other words, there's a certain defined number of parties who are members of this, and that's typically the individuals who are the that are the shareholders. What is included in the sale? So example, the blue sky, the accounts receivable, equipment. Again, it's all about the valuation and how you establish the value of the shares of the individuals. What kind of events can trigger these buy-sell agreements? And typically, we've been talking about death and disability, but in some cases, divorce, retirements, other types of things are other ways of or other events that can be included in a buy-sell agreement. The price is a description for the determining the fair market price of the funds. The funding is how the transaction will be funded, obviously enough. And as I mentioned, the most common way that people do it simply because they aren't prepared is there's a unfunded mandate. A partner dies, they have eventually come to a level of evaluation on the shares, and then the remaining party is on the hook for paying for that. And then they try to figure out how that's going to happen. Are they going to pay for it all at once? Are they going to try to create a payment schedule from the cash flow or accounts receivable? There's a lot of different options over there, but any way you look at it, that money has to be taken out of either the company or taken out of the pocket of the remaining owners. And so what happens that is a very difficult issue to deal with. And then the terms of sale are also other elements that you talk about with the buy-sell agreements. You know, is it going to be a certain amount down? How long are they going to pay for it? How are they going to pay for it? And at what point in time do you want to have this entire event concluded? And as I mentioned before, the legal documents or the agreement itself should be created by an attorney, and the funding of the agreement can be done affordably and more easily through the purchase of the like I said, a term type of life insurance, which is relatively inexpensive, or if you wanted to include the disability on that, the disability buy-sell agreement insurance. And that way it takes a lot of this consternation at the end of the event over funding and takes that funding and kind of moves it over a longer period of time with a much smaller premium every year, so that you don't have get hit with that large bolus of necessary funding in the event of a life event that requires the execution of the buy-sell agreement. Okay, let's go to the next slide. So how do you create a plan for your practice? And I think the way to think about this is, first of all, you have to have the partners understand and agree to creating a buy-sell agreement. I mean, that's the first step. If you can't do it until you agree to be able to do it. At that point, you can consult with an attorney, talk about the different issues, and create that buy-sell agreement. And then you're going to create a list of essential items that you want to pre-negotiate and include in the agreement. Now, the important point of pre-negotiation, I can't be overstated, because when you're not in the environment where you have two different parties battling over the valuation or anything like that, you can talk more rationally and come up with a common ground that you can end up using as a common form of valuation for those elements that they're going to be selling. If you decide you want to go with a funded insurance policy or a funding through an insurance policy, you can then enlist the use of an agent to be able to help place those policies, then execute the buy-sell agreement between the parties. I think it's also important that the partners' families are aware of the provision of the agreement, and the partner may wish to incorporate this document into their own individual estate planning. And then last of all, you need to regularly review the agreement. I'd probably say on an annual review or annual period of time, review it very quickly for the provisions and assumptions and valuations. Certainly needs to be reviewed anytime there's an addition or subtraction of partners. And then you make the necessary changes and updates. And the review should really include all partners each year on an annual basis. Let's go to the next slide. I think we already touched on this. We can probably just burn through this quickly. In other words, we talked about death, but it could also happen from a long-term disability where the individual is no longer able to practice and they want to be able to buy out their shares. It's kind of like a forced retirement in a sense, but nevertheless, with a retirement, you're going to be able to have level of planning ahead of this, but typically with a death or disability, you don't have planning. So it makes it more difficult to be able to do it on a short-term basis or a very quick basis. And you want to be able to be aware of it through that plan. Next slide. This is just a quick summary of this. I actually have this in a handout, which I have available. I'll make it available to everybody as far as where they can download this. But this is the value of a buy-sell agreement when there's no agreement in place. We talk about the death or disability, the evaluation of the ownership, the transition, the execution of, and the outcome. This is again for without an agreement. Next slide. This is the same thing, but shows the differences with a buy-sell agreement. And again, I'm not going to go over this because we just covered this, and I want to be able to just have this as a nice summary for you to remind you when you end up downloading the handout. So I think one thing I just didn't want to cover briefly is where did I come up with all of the information on this and the experience? Well, I have been a practicing pathologist for over 40 years in laboratory medicine. I have been a staff pathologist. I've been a chairman. I've been a medical director. I even started my own laboratory from scratch, built it up, and then sold it. So, and I've pretty much seen all the different phases for pathologists and been able to interact with all of the needs for insurances and also all the business issues that come up over that. Now, what happened is I retired from full-time practice in 2019. And in that in that situation, what ended up happening is I ended up partnering with a friend of mine, and we started a insurance brokerage called White Coat Risk Management, and that is specializing in the needs of physicians. And the nice part about it is with my background, I have a better understanding of what really what the issues that physicians actually face. And the insurance companies and the insurance agents really don't understand that background. With my training in and experience in medicine, and also now with my obtaining of my license in insurances, I'm able to provide that bridge between the knowledge of the insurance agency and also the needs of the physician. And I am able to function as a nice bridge for that. And many, many times, I see two parties talking, and I'm able to walk in and be able to help individuals, again, bridge that void of knowledge. And then last slide. I just want to make sure that everybody's aware that we do not provide legal advice on buy-sell agreements. That's something that should be done by your attorneys. Nothing in this presentation should be considered personal legal advice on how to construct these arrangements. And of course, any decisions you make or fail to make remain your sole responsibility. I love the new world we live in where we have to be able to put these kind of disclaimers, but I think it's important for people to do that because, again, these are complicated issues. And I think buy-sell agreements for medical practices is a relatively unheard of concept. This is not a new concept as far as management in business, but perhaps it's under-realized and underutilized in medical practices. And from my situation now in White Coat Risk Management, if you do end up generating a buy-sell agreement for your practice, and you need the financing or the ability to be able to create those financing vehicles used through insurance products, I'm able to help out with that. And again, you'll have the unique ability of you'll have the unique assistance of someone who knows both the medical and the insurance background. So with that, I'm going to wrap it up and we can ask any questions that we have.
Yeah, thank you again, Dr. Ruby. And want to just say thank you to Ann and Josh as well for their portion on the AR discussion. We did receive a few questions in the Q&A that I tried to answer throughout the presentation. But if you did not get an opportunity to ask a question, we're going to go ahead and wrap up here. I will be following up with a recording and slides, hopefully this afternoon, but no later than tomorrow morning. If you have a question, you can forward it back to me and I will send it to the appropriate person and see if we can get it answered for you. But thanks again to everyone and enjoy the rest of your day.